Lock in, because what's happening right now across global markets is not normal. We're watching two massive events collide in real time, and both of them are sending gold and silver into territory we haven't seen in years. On February 20th, 2026, the Supreme Court delivered a 6-3 ruling striking down President Trump's sweeping tariff regime. The court ruled that Trump exceeded his authority by using the International Emergency Economic Powers Act to impose his reciprocal tariffs. This wiped out tariffs on $1.2 trillion worth of imports overnight. But that same day, something else happened that most people aren't paying attention to. Gold crossed $5,000 per ounce for the first time in history, as tensions between the United States and Iran reached levels not seen since the brink of war. Oil prices jumped to their highest level in nearly 7 months, and military assets are moving into position across the Middle East. Trump gave Iran a deadline, 10 to 15 days at most, to strike a deal over its nuclear program. Really bad things will happen if no deal is reached, Trump said. The US will get a deal one way or the other. Translation: military action is on the table, and the clock is ticking. Right now, you're watching two completely different market forces converge. One is deflationary. The tariff ruling could lower consumer prices and reduce inflation pressure. The other is inflationary. A war with Iran could send oil prices soaring and trigger massive supply shocks across global markets. And gold is caught right in the middle, trading more like a meme stock than a safe haven. Enormous volatility, wild swings. But the rising tensions in the Middle East sparked a fresh bid for haven assets, lifting the metal's price above the $5,000 threshold. In the next several minutes, I'm going to break down exactly what these two events mean for your portfolio. Why gold hit $5,000, why silver is exploding, what the tariff ruling actually changes, and most importantly, how to position yourself when nobody knows which direction this thing breaks. The Supreme Court just rewrote Trump's trade war. Let's start with what just happened with tariffs, because this is massive. On February 20th, 2026, the Supreme Court ruled in a 6-3 decision that the International Emergency Economic Powers Act does not authorize the president to impose tariffs. Chief Justice John Roberts delivered the opinion. Justices Clarence Thomas, Samuel Alito, and Brett Kavanaugh dissented. This is a huge blow to Trump's signature economic policy. The IEEPA tariffs made up most of the tariff regime put in place over the course of 2025. The most recent estimates from U.S. Customs and Border Protection show that $142 billion will have been collected from tariffs enacted under IEEPA authority over the course of 2025. Here's what it means in practical terms. Before the ruling, consumers faced an overall average effective tariff rate of 16.9%. After the ruling, that drops to 9.1%. That's still the highest since 1946, excluding 2025, but it's a massive reduction. The price level impact drops from 1.2% to 0.6% in the short run. This represents a loss of about $800 for the average household instead of the $1,500 it would have been with IEEPA tariffs intact. But here's the catch. Trump isn't backing down. Within hours of the ruling, Trump announced a new 10% global tariff using different legal authority under Section 122 of the Trade Act of 1974. Then on Saturday, he raised it to 15%. The tariff applies to $1.2 trillion worth, 34% of annual imports. It's scheduled to expire after 150 days. But the message is clear. Trump is not giving up on tariffs. He's just using different tools. Markets reacted with confusion. Stocks rallied initially. The Nasdaq rose nearly 1%. The S&P 500 added 0.7%. Retailers like Walmart, Target, Costco, and Amazon immediately became some of the best performing stocks because they benefit from lower tariffs. But by Monday, February 23rd, the rally reversed. The S&P 500 fell 1.18%. The Dow dropped 1.67%. The Nasdaq fell 1.38%. And gold surged 3.20% to $5,243. Why? Because uncertainty is back. Nobody knows what Trump will do next. Nobody knows if the 15% tariff will stick or if he'll find another legal workaround. And uncertainty is exactly what gold loves. The Iran crisis. Nobody saw coming. Now let's talk about the elephant in the room, Iran. Because this is the real driver pushing gold above $5,000. And most people have no idea how serious this has become. On January 28, 2026, gold hit $5,589 per ounce, the highest price in history. That was the day tensions between the US and Iran escalated to the brink. Trump threatened a major strike on Iran after the government violently cracked down on protests. But that same day, something else happened. The Federal Reserve decided to hold interest rates steady at 3.5% to 3.75%. Markets had been pricing in rate cuts. When the Fed held, it should have been bearish for gold. Higher rates mean higher opportunity cost for holding a non-yielding asset. But gold exploded anyway. It rose over $300 in a single day. This is the new paradigm. Gold is no longer just reacting to interest rates. It's reacting to trust. Or more accurately, the lack of it. Right now, as I'm recording this, the prospect of conflict in Iran raises fears about shocks to oil supply, which could send prices soaring. About 20 million barrels of oil flow through the Strait of Hormuz every day, according to the U.S. Energy Information Administration. That's equivalent to 20% of global oil consumption. Iran in recent days said it partially closed the Strait of Hormuz for planned naval exercises, according to Iranian media. The latest move signals a market strengthening an already notable geopolitical risk premium as the world's most important oil artery sits within striking distance of a conflict. Brent crude rose to around $70.50 a barrel after surging more than 4% in the previous session. U.S. crude climbed above $65. Oil prices jumped Thursday to their highest level in nearly 7 months. But here's what should terrify you. Satellite images show Iran has been fortifying its missile bases. A building at Iran's Qom missile base had roof damage on July 16, 2025, and the same site shows a new roof on February 1, 2026. Iran's Shiraz South missile base shows reconstruction and repair work completed between July 2025 and January 2026. The combination of hardened facilities, ongoing military readiness, and persistent diplomatic negotiations reflects Tehran's dual strategy, safeguarding strategic infrastructure while keeping open the possibility of a negotiated settlement. Tracking site Flight Radar 24's data showed a surge of flight activity by U.S. military transport, aerial tankers, surveillance aircraft, and drones to bases in Qatar, Jordan, Crete, and Spain. Top U.S. national security advisors met in the White House Situation Room on Wednesday and were told all U.S. forces deployed to the region should be in place by mid-March. This is not saber-rattling. This is the largest U.S. Air Force deployment to the Middle East since 2003. Stealth fighters, aircraft carriers, the full arsenal, and Iran is conducting joint military exercises with Russia near the Strait of Hormuz. Why gold is acting like a meme stock. Here's where things get interesting. Gold in recent weeks has traded more like a meme stock than a safe haven, with enormous volatility and swings in prices. But the rising tensions in the Middle East sparked a fresh bid for haven assets, lifting the metal's price above the 5,000 threshold. Daniel Pavlonis, senior market strategist at RJO Futures, said, "We're being whipsawed and moving sideways with volatility. Tensions with Iran are supporting gold, and while the broader outlook remains quite bullish, we could still see one more leg down driven by factors outside the Iran situation." Think about what's happening here. Gold is caught between two massive forces. On one hand, you have the tariff ruling, which is potentially deflationary. Lower tariffs mean lower consumer prices, lower inflation pressure. That's typically bearish for gold. On the other hand, you have Iran, a potential war that could send oil prices through the roof. More immediately, strikes on Iran would risk causing oil prices to jump and threaten to boost inflation in much of the world, reducing the pace or number of interest rate cuts by major central banks. This is the exact setup that creates violent price swings. Nobody knows which force wins: deflation from tariff relief or inflation from oil shocks. So gold whipsaws between $4,900 and $5,200, trying to price in both scenarios simultaneously. But here's the critical insight. Even with all this volatility, gold is holding above $5,000. That tells you something fundamental. The market believes the Iran risk is real, and the safe haven bid is strong enough to overcome everything else. The silver explosion nobody is talking about. While everyone focuses on gold, silver is quietly staging one of the most explosive rallies in years, and almost nobody is paying attention. Spot silver jumped 6.9% in late January 2026. It hit a record high of $117.69 on Monday, January 27th. Silver has surged more than 55% so far in 2026 after recording a 146% gain in 2025. Let that sink in. 146% in 2025. then another 55% in the first 2 months of 2026. This is not normal price action. This is a parabolic move. Why does this matter? Because silver is both a monetary metal and an industrial metal. It's used in solar panels. It's used in semiconductors. It's used in electric vehicles. Demand is structural, and supply is constrained. Bank of America now has a price target of $170 for silver. Citi upgraded their short-term silver forecast to $150 from $100. Silver is more volatile than gold, but it also has more upside. When gold moves, silver moves faster. And right now, both are moving in the same direction. Up. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is compressing. That's bullish for silver. What the conflicting signals mean for your portfolio. So how do you position when you have two massive forces pulling in opposite directions? The tariff ruling is deflationary. The Iran crisis is inflationary. Markets are confused. Gold is whipsawing, and nobody knows which way this breaks. Here's the framework. You need to understand that we're in a regime where geopolitical risk trumps everything else. Interest rates matter, inflation matters, the Fed matters. But when missiles start flying, none of that matters anymore. Safe haven assets win. The balance of risks now tilts to a U.S. strike after market close Friday, said Michael Every, senior global strategist at Rabobank, adding that any military action could last weeks rather than ending quickly. If that happens, oil goes vertical, gold goes vertical, silver goes vertical, and everything else gets sold. But even if diplomacy prevails and the Iran crisis de-escalates, you still have the tariff chaos. Trump just imposed a 15% global tariff effective February 24th. The EU postponed ratification of its trade deal with the US. China is scrambling to figure out what the new rules are. Uncertainty will continue to be the name of the game. In this environment, gold and silver are not optional. They're essential. Not as trades, as insurance. Because the one thing we know for certain is that the next few months are going to be volatile. And volatility creates demand for assets that don't depend on anyone else's promise. The 3 positions you need right now. First, hold physical gold, not paper gold, not ETFs, physical metal you control. 5% to 15% of your portfolio, depending on risk tolerance. Gold just proved it can hold $5,000 even with interest rates elevated and the dollar relatively strong. That tells you the safe haven bid is structural, not temporary. Second, add silver exposure. The risk-reward on silver right now is asymmetric. If gold goes to $6,000, silver could easily hit $200 based on historical ratios. Bank of America's target of $170 is not fantasy. It's based on supply-demand fundamentals and monetary debasement. Third, watch oil and energy stocks. If the Iran situation escalates, energy becomes the trade. But be selective. You want companies with pricing power, low debt, and dividend sustainability, not speculative drillers that go bankrupt when volatility hits. Conclusion. Here's the brutal truth. We're watching 2 crises collide. The tariff ruling should be deflationary. The Iran crisis is inflationary. Markets don't know how to price this, so they're doing what they always do in confusion. They're buying gold. Gold crossed $5,000 not because inflation is out of control. Gold crossed $5,000 because trust is breaking down. When the president threatens war. When the Supreme Court strikes down his signature policy. When missiles are being fortified and military assets are moving into position, trust breaks down. And when trust breaks down, gold wins. Every single time throughout history, no exceptions. The question isn't whether you should own gold and silver. The question is whether you're positioned correctly before the next leg higher begins. Because when Iran makes its next move, when Trump retaliates with new tariffs, when oil spikes or the dollar cracks, there won't be time to reposition. The move will happen overnight, and you'll either be holding real assets or watching from the sidelines. If this breakdown opened your eyes, hit that subscribe button right now. Drop a comment telling me how you're positioned. Are you holding gold? Are you buying silver? Are you waiting on the sidelines? I read every comment. The clock is ticking. Iran has 10 to 15 days. The tariffs take effect February 24th, and gold is sitting at $5,000 waiting to see which crisis wins. Position accordingly.